Inflation has risen again from 1.7% below the 2% target to 2.3% in October. And naturally, if that concerns you, you're not alone, because it's easy to think if inflation increases, interest rates will increase. So in this video, I'm going to walk you through the facts so you can decide for yourself if they're going to go up or down. And in case you don't know me, my name is Gale, and the reason this is so important to me is I've spent over 10 years now building a UK-wide home buying company, British Home Buyers, a nationwide estate agency, British Home Sellers, and my own personal property portfolio. So not only does that give me a bit of inside knowledge, but also making sure I read the market correctly is essential to mine and my clients' success. So let's get into it. The best way to figure out if interest rates will rise or fall is to get into the heads and mindsets of the Bank of England themselves that actually set these rates. And the best way to do that is to read the monetary policy report released from the Bank of England earlier this month. It's a quarterly report by the Bank of England that basically explains their reasoning for interest rate changes, and they share their inflation projections for the future, taking into account lots of different things they measure. And so they take into consideration the effects of the new budget, for instance. So this report gives us all a really good indication on if interest rates should go up or down and so on, and what affects the decision. It gets us in their heads, so to speak. Now, I've linked the 90-page report in the description below, but of course the whole point of this video aims to condense that report down into a 10-minute chat between you and me on what I believe the highlights are from it. But of course, if you fancy reading it, by all means feel free to. It is actually super interesting. So I want to start with the Consumer Price Index, CPI. The CPI is that 2% inflation figure you'll see all over the news. And of course, it's what the Bank of England themselves use for that 2% target they keep talking about. So we're all used to seeing this target out there in the world. However, one thing I want to point out about it is the CPI doesn't take consideration the cost of owning and maintaining a home. To understand that, you need to look at the CPIH, which is essentially identical to CPI, but the added H stands for housing. So it adds in owner-occupied housing costs. So things like your mortgage, maintenance costs, and council tax. Now, the CPIH has also increased from 2.6% to 3.2%, so not looking ideal either. Now, you might be thinking, why is all the focus on the CPI when that doesn't reflect the full cost of living, as it obviously doesn't include housing costs, which for most of us are a major cost in our monthly costs? And the answer to that is debatable. On one hand, internationally, the CPI better matches the HICP that's used across Europe to measure the same sort of thing. So it offers a better comparable to that, for instance. On the other hand, it's argued if you include housing, the variations of housing costs don't actually directly impact the prices of goods and services, not in the same way that higher energy costs do, for instance. But I think a lot of people think it's a deliberate way for the government to reduce inflation-linked costs. For instance, the pensions triple lock is based on CPI, as are benefits and tax thresholds. So although CPIH is probably a better representation of the real cost of living pressures that we all face, and what you'd assume would make more sense to measure against, in reality, measuring inflation against CPI instead is, well, it's cheaper for the government. So why has inflation risen? The report pinpoints several factors driving inflation in its view. One, energy prices. While energy prices have been more stable recently, the past spikes are still working their way through the economy. So For example, businesses that faced higher energy costs last year may only now be passing on those costs to consumers now. 2, wage growth. Wages have been growing at a faster pace as businesses compete for workers in what is quite a tight labour market right now. This is obviously great news for employees, but it also contributes to inflation because businesses in reality pass these higher costs in the form of price increases on whatever they sell. And of course, 3 global factors. The UK is not isolated, although an island. Supply chain disruptions, geopolitical tensions, and higher commodity prices globally are also going to be playing a role in this. But a more recent curveball is the Bank of England report directly looks at the impact of the recent autumn budget on inflation. The bank actually projects the budget measures will increase inflation by about 0.5%, which you might be thinking, well, how? Because the government are going to be increasing public spending by about £70 billion a year, funded by all the tax increases, but also debt, which is again more money being pushed into the system that the Bank of England anticipates will lead to inflation staying over 2% for longer. As you can see from this table, they now expect inflation to stay above 2% a full year longer than previously expected. Now they're expecting it to return to target by mid-2027, not mid-2026 as previously thought. So what's this mean for the housing market and for interest rates? As you probably know, most mortgages are held on a fixed rate, usually 2 or 5 years, and about 2/3 of the stock of mortgages are actually currently on 5-year fixed mortgages. This means that there are still loads of households that took mortgages out prior to the sharp rise in interest rates back in 2021. So they still haven't felt the effects of high interest rates on their mortgages right now. Right now, there are around 800,000 fixed rate mortgages currently with an interest rate of 3% or below that are expected to refinance each and every year until the end of 2027. So naturally, every month that passes where mortgage rates are up at that 5-6%, it's going to put pressure on more and more people having to refinance off their previously far lower interest rate products. All that creates pressure on the property market, but also the only thing that is ultimately going to ease that is interest rates dropping. So what are the projections on inflation right now? So the report models inflation projections under different scenarios. So if the exchange rates change, or oil and gas prices change, or government spending changes. And you can see here this graph does a great job of illustrating just how broad the projection on inflation actually is. Obviously, the dark orange area is the most likely projection, and then as it gets to the lighter orange, it models in more, I guess, unlikely scenarios. But it really illustrates in a way that it really isn't a given inflation will fall as much as we'd like, and therefore interest rates will fall as quickly as we'd like. Currently, the bank expects inflation to gradually return to that 2% target over the next 18 to 24 months. However, that depends heavily on factors like global energy markets, wage growth, and ultimately how quickly businesses pass on the costs to consumers. So what does this mean for interest rates? Well, if inflation stays higher for longer, we'd probably see interest rates stay higher for longer too. Or dare I say it, interest rates increase a little. But I'd be personally surprised if rates increase, as I think the most likely outcome is rates will just drop more slowly rather than increase. Reason I think this is the report includes a forecast summary. You can see from this that the Bank of England is actually expecting CPI inflation to actually increase over next year to 2.7% and then start dropping through 2026 and 2027. And the bank rate at the bottom of the table shows forecasting of Bank of England interest rates averaging at 3.7% Q4 2025 and 2026 to then start dropping further to 2027. Now, this is not the Bank of England saying they will drop rates to this level. It's based on current swap rates. Essentially, the market predicting bank rates in the future that the report is actually quoting. So the fact the report includes these projections sort of implies they think it's relevant without actually explicitly saying we are going to drop rates in the future to this specific level. So will inflation increase interest rates? Well, no, because the Bank of England has already expected and was expecting inflation to increase a little anyway. Next, in fact, they are expecting inflation to increase a little over the next year to 2.7%. The thing that has changed is it's expecting inflation will take about a year longer to consistently hit that 2% target than previously thought, partly due to the budget projected to add 0.5% to inflation. So the conclusion is, although interest rates dropping to 4.75% more recently, general mortgage rates have actually gone up, not because there is an expectation that the Bank of England will increase rates in the future, but because the Bank of England rate is expected to take longer to drop than previously anticipated. So all these products are pricing that in. The key takeaway from this report is that clearly inflation is still a concern and the Bank of England is likely to remain very sort of careful and vigilant about it. But I don't think any of us should be panicking. I'd love to hear your thoughts. Do you think I'm wrong and the Bank of England will raise rates again next year, the year after? Share whatever you think. And as you know, I pretty much respond to all your comments down below. I'll see you in the next video up here.